Dear friends, welcome to Allen's Academy of Commerce. Today we are going to see about the objectives of financial management. So, for judgments to be made as a crucial financial decisions, you need to have certain objectives. Based on the objectives, the decision should be finalized by the financial managers. So, objectives of financial management should be taken into consideration based on the needs of that particular concern at that particular point of time. So now, what are the different objectives we are going to see now? Financial management is diversified based on these objectives. Among that, the first one is the basic objective and other objectives. So now, basic objective, you have two diversifications, profit maximization and wealth maximization. So we are going to study in detail about both these concepts for today's class. So now, what do you mean by profit maximization? As already you know, every concern, behind the concern, the maximum profit should be attained. That is the basic goal of every concern. So now, there are certain arguments which speak in favor of profits and criticizes about this profit maximization. So what is profit maximization is? The objective of financial management should undertake those activities which give them maximum profits. So this ultimately gives an idea about as what in the previous class, as I've told you, to come up with decision making process. The decision makings will be based on investment decisions, financial decisions, dividend decisions. So for that purpose, this idea should be taken as the base, profit maximization. But the profit maximization idea gives certain arguments which favors this and which criticizes this. So now we are going to see about the first concept, argument in favor of profit maximization. So the first point under this is profit is a yardstick. What do you mean by yardstick? In order to determine the economic efficiency of a business, the profit should be evaluated. In order to determine the economic efficiency of a business, the profit should be evaluated. So it is a yardstick. Now here, the economic efficiency, how the economic efficiency can be determined is the second point what is given to you. Efficient utilization of scarce resources. You know, the resources are scarce. For example, if you take up gold, it is scarce. If you take up coal, it is scarce, the resources. If you take up steel, iron, it is a scarce resource. If you take up crude oil, it is a scarce resource. So all these are scarce resources in an economy. But only if these scarce resources are efficiently utilized, that will lead to profit. So profit serves as a yardstick because the economic efficiency can be determined only by utilizing the scarce resources to the best possible manner. Now, when the utilization of the scarce resources to the maximum possible extent is concerned, that leads to the third point, rate of return on capital employed. This becomes the best measurement. What is this rate of return on capital employed? See, in financial management, for every words you have a depth meaning. So in the later classes, we'll go in for the wide aspects of this, but just to give you an idea about what do you mean by this rate of return on capital employed. I'll just tell you. It is a financial ratio which determines the company's profitability and efficiency on capital applied. So two aspects are there. It determines the company's profitability and efficiency on what? On the capital employed. So what do you mean by capital employed? This profitability has a sequence to the capital employed, or the return has an equalization or a sequence to capital employed. This goes hand in hand. So if the returns are to be high, then the capital employed should be effectively utilized. So what do you mean by this? Again I say you, higher the rate of return, more economical is the use of capital. When the rate of return goes high, then the capital employed or the capital is used, the capital funds are used efficiently. That is the meaning. So if the rate of return on capital employed is more than the capital cost, then the company leads to higher profitability. Once more I say you, if the rate of return on capital employed is more than the capital cost, then that is the best measurement which leads to more profitability for a concern. So in other words I say you, what do you mean by, first of all I told you, rate of return on capital employed is more than the capital cost. So what is this capital cost? You have to know. Capital cost is none other but it is a one-time payment for the purchase of assets, fixed assets. So every time the company doesn't purchase the fixed asset very often and then, but only it will become a one-time purchase or a one-time investment which leads large amount of finance for investing on the fixed assets. So now if the company is going to invest in the fixed assets, and if not the fixed assets are utilized efficiently, that leads to the loss. The fixed assets purchased should not be kept idle. It should be utilized effectively so as to increase the profits. Therefore, the production or the productivity or the efficiency should be increased by utilizing the fixed assets. So that becomes the capital cost for the concern, and when it is utilized efficiently and effectively, automatically the rate of return will increase for the concern, which leads to higher profitability. So this becomes the best measurement. That is what is the meaning. So now I am clear that you would have understood the meaning. Okay. Now the next, so because it is the best measurement, the next point comes, profit acts as a motivator. So all the assets which are utilized by the concern is utilized in a very effective and efficient manner because the resources are scarce. It is only the one-time purchase, so that should not become idle. It should be utilized effectively and efficiently so as to increase in production, and ultimately there will be an increase in profit, and hence profit serves as a motivator. Next, it leads to the social and economic welfare. So for this purpose, profit serves as a yardstick. So the profit maximization, there are certain arguments which favor the profit maximization for every concern. This is a general favorable argument. Now we pass on to this. There are certain criticisms also against profit maximization. So let us see one by one in detail about this. So now we are going to see the criticisms against profit maximization. So the first criticism against profit maximization, it is ambiguity. What do you mean by ambiguity? It is not clear. It leads to certain, deviations. We cannot concretely calculate. So that is what I mean by ambiguity. Certain precisions are vague. That is what is meant by ambiguity. So first point is vague and ambiguous concept. So what they say is, every concern who aims for profit maximization The concept should be crystal clear, but it is somewhat vague. Why it is vague? Because it lacks precise connotation. So what I mean by precise connotation is every person take it in a different view. For every organizations, the profit is different. The profit is different in different views. Okay, so now what lacks precise connotation means different interpretations. There are different interpretations for different people, different organizations about profit. So what can be the different interpretations? We are going to see one by one. Short-term or long-term profit. For some organizations, it may be a short-term profit. For other organizations, it may be a long-term profit. So here itself, there is different interpretation of views based on the needs of the concern. Next, some organizations or some business firms takes it as total profit or rate of profit. Next, net profit before tax or net profit after tax. For some concerns, it may be net profit before tax. They may be accounting for that. For the other concerns, it may be net profit after tax. So these are different views of different concerns. For one concern, it may be return on capital employed. And now, some of the concerns goes for total assets or shareholders equity. Some concerns, they opt the first preference for increasing the shareholders wealth. For every concerns, the way of seeing to the profit maximization may differ. That is what is the first argument or the criticism for profit maximizations. Okay, so first is about ambiguity as what we saw. Next, we go in for the next criticism, time value of money. Time value of money, particular definition for time value of money is in an income received today or a rupee received today is more valuable than a rupee received tomorrow. That's the definition for the time value of money. Once more I'll tell you. A rupee received today is more valuable than a rupee received tomorrow. So what do you mean by this? See, the income will differ for every year. That need not have equal weights. The weights differ. Okay. So, if at all a rupee received today, it has more value. It has a greater value. So, how can we know about this? I'll give you the same aspect with an example in my next slide. There are 3 years here. Year 1, Year 2, Year 3. There are 2 projects, Projects X and Project Y. Now the income earned in both years are given to you. For the first year, the Project X had an income or a profit earned generated to be 10,000 rupees. For Project Y, it is nil. Now for the second year, it is 20,000 for both the projects X and Y. Now for the third year, for Project X is 10,000 and for Project Y, it is 20,000. When you add up the total, for Project X, the total amount comes as rupees 40,000. Similarly, for Project Y also has 40,000. Both these income as equal measures, 40,000, 40,000. But when you take up individually for the first year, Project X has income earned of rupees 10,000, whereas Project Y doesn't have any income. So now, when you ask the question, which project is more better, whether Project X or Project Y, now I can tell you Project X is more better than Project Y because the first year's income generation of rupees 10,000 can again be reinvested by the concern to earn more profits when compared to Project Y, because in first year Project Y didn't earn any income, but whereas Project X has earned an income of rupees 10,000. So now we can come to a conclusion that project X is better than project Y. This is the idea. But here, why the criticism happens is that has ignored profit maximization, has ignored the time value of money. When you say both have equal income generation, 40,000, 40,000, but the specification is first year's income would have, if reinvested, would have generated more amount of profitability in the later years. This concept is not there in profit maximization. That is why they tell profit maximization ignores time value of money. So we'll come to the previous description. That is, a rupee received today will have greater value than a rupee received tomorrow. So now for project X, 10,000 rupees has more greater value than the income received in the subsequent years. Next, the value of income received in the first year will have greater value and the initial profits can be reinvested to gain more profits. That is the idea behind the time value of money. This idea is ignored in profit maximization. That is what the second criticism. Now we'll go with the risk factor. For every business concern, risk is inevitable. The risk can be a minimum or maximum based on the structure, the concern's organizational climate, etc. That differs. So every concern has to take a risk. Risk is an inevitable factor. Now, the profit maximization ignores to tell about this risk factor. That is the third criticism. So now, what do you mean by this? High uncertainty increases risk. What is high uncertainty? It cannot be predicted. Certain risk can be predicted, certain cannot be predicted. Certain can be controlled, certain cannot be controlled. So when it is going to be certain infrequent, certain fire accidents or something like that, the company would have insured for that. Okay, so that need not happen, but if it happens, there can be compensation and claims from the part of the company through the insurance company. But certain things the company cannot predict. It comes beyond the control of the company. So high uncertainty increases the risk. The company has to bear more amount of risk for high uncertainty happenings in the concern. Less uncertainty, in other words, it reduces the risk. Therefore, the concern has to see about this, the risk and the returns. There should be a proper balance about the risk and the return. In the next classes we can see about this. But before that you have to know, less income with more certainty is better. Every concern always want to get minimum returns. But this minimum returns with more certainty, this risk may happen. So if at all the risk happens, we can tolerate that, we can compensate that risk, but we get a less income only. Then that is more better. What the company says or what the firm says is less income with more certainty is better than what? Higher income with high uncertainty. High income, the company takes more amount of risk. There are so many projects coming up with high fluctuations. For example, see as we also, we being an investor, if you are going to invest in share markets, that incorporates high amount of risk. Whereas, if we are going to purchase bonds, that is less risk for us. That gives us a fixed income, a fixed rate of income. And we are more certain about the economic situations. But we feel that it gives us less income, but at the same time, our income will be stable So there is a certainty that we can get an income. But whereas when we are going to invest in share market, based on the fluctuations, based on the economic balances, sometimes if the economy if there is going to be any imbalance happenings, then we cannot determine that we'll get a favorable income. Our income totally vanishes. Therefore, in the same way, for a big giant companies, if they're going to take up more amount of risk, which is highly uncertain, then what will happen? The welfare of the shareholders cannot be maintained, so that doesn't give us a favorable balance, because the profitability cannot be attained. Okay, so now that is what is the comparison. So less income with more certainty is better than high income with high uncertainty. So now the risk factor is not predictable in profit maximization, whether the company takes a high amount of risk or low risk. Now, if at all the income can be highly gained or there will be no income, this cannot be predicted very easily in profit maximization. Therefore, this is the third criticism in profit maximization. Hope you are clear. So thank you for watching these videos. Kindly, if you like it, click on to the like button. Kindly subscribe for Alan's Academy of Commerce. It will be an encouragement for all of us to give up more videos for all of you, and give your valuable comments also. Thank you.